The Federal Reserve Bank is getting worried about our economy, but it doesn't look like they're willing to make the difficult decisions to actually fix our economy. Over the weekend, I published a video because Jerome Powell, who is the chairman at the Federal Reserve Bank, gave an interview where he said that the United States government is heading down a, quote, unsustainable path because our national debt levels are growing faster than our economy. Now, you don't have to be a financial genius to know that if your debt is growing faster than your income, you have a problem. And that's exactly what he said. And then he went on to say that we need to fix this problem by disincentivizing the government from borrowing so much money and spending so much money. Makes sense. But then it looks like things changed because just yesterday, one of the top headlines is that the Federal Reserve Bank is almost guaranteed to cut interest rates next week on December 18th when they meet again, which might have you scratching your heads. If you just said we're heading down this unsustainable path because our debt is so high, because our debt level is growing so fast while our economy isn't keeping up, shouldn't we not be cutting interest rates? But then we have the third piece to the puzzle, which is that we have a brand new president entering the White House in January. President-elect Trump has his own economic policy. He has been very adamant about wanting lower interest rates in 2025 and beyond. And then he was asked that if Jerome Powell doesn't do as you say, would you fire him? This just happened over the last couple of days. And he said, no, he will not try to remove Jerome Powell if he doesn't listen to Trump based off of the information that we have today. So what I want to do in this video is break all of this down. And I also want to talk about what's happening in China because China is now unleashing a new stimulus program to combat future tariffs that might be coming in 2025. So let's talk about all this. But first, I want to give you a quick shout out and thank you because over the weekend, my YouTube channel, Minority Mindset, also hit 2 million subscribers for the first time ever, which is absolutely mind-boggling. I would have never thought that there would have been millions of people who would want to watch this random guy on YouTube talk about all things money and guacamole. So I appreciate your support. I appreciate your love. And of course, I appreciate all the extra guac that you send my way. So thank you all for the support. Thank you all for the love. And thank you for all the time that you've given me. I hope that I have been able to return it with the financial value and the financial education. So it really does mean the world to me. Thank you all for the support. And with that, let's go into this. What's going on with the Federal Reserve Bank? So if you haven't seen my video from the weekend, I'll link it for you down in the description. I'll also link an article for you going over what Jerome Powell said. But Jerome Powell essentially highlighted that we are seeing our national debt levels grow faster than our GDP, which is a concern because the United States government is borrowing so much money and spending so much money that they don't have. And he says that if we're spending all this debt, we should actually have a much stronger economy than what we have today. We should actually have a much stronger job market than we have today, which seems a little weird because if you look at all the data says that the job market is very strong. The economy is very strong. And he says that you're looking at it the wrong way because he says that a job market should be even stronger. The economy should be even stronger. Now, I get it. A lot of people are saying, hey, the job market really isn't as strong as the data says. The economy doesn't feel as strong as the data says. And this is because we're really seeing a tale of two economies, where on one hand, investors have gotten very rich. Over the last 5 years, the stock market is up around 90%, while over the last 5 years, incomes are only up around 20%. While over the last 5 years, inflation is also around 23%, which means if you're just surviving on your income from your salary, you've probably become poorer. Versus if you are an investor, you've become disproportionately wealthier. Likewise, in the job market, the people that have good jobs have probably seen a lot of investment versus people that don't are not seeing that advancement. So you have some people in the job market that are seeing a lot of success versus some people are not. And that's where it's really a tale of two economies that we're seeing right now. And this is where Jerome Powell really gave an interesting piece of data, which is that, yeah, it's strong according to the data, but it should be stronger. We should have an even better job market and an even better economy because the government is borrowing so much money. Remember, in 2024, we have the third largest national deficit in the history of time, which means the United States government is spending almost $2 trillion that they don't have in 2024 to stimulate the economy, to stimulate markets. Which is interesting because normally you do that during a time where you are in a down economy. right? We stimulated in 2020 because we were in a recession. We stimulated in 2008 because we were in a recession. We stimulated in 2001 because we were in a recession. But in 2024, we're in supposedly the strongest economy of all time, yet we keep stimulating the strong economy, and this is where Jerome Powell says we might have a problem. Now, this is where the Federal Reserve Bank is meeting on December 17th and 18th, and they're going to decide what they want to do with interest rate cuts. And we've been covering all of this in Market Briefs, which is my free financial newsletter, but there is, according to Wall Street, an 85% chance that the Federal Reserve Bank is going to cut interest rates again on December 18th, which means we're almost guaranteed to see another interest rate cut, which might seem a little bit weird. Why are we cutting interest rates if debt is a problem? Because lower interest rates are there to stimulate spending. But the interesting thing about that is it's not there to stimulate people just spending money out of their bank account. It's stimulating spending through more debt. See, in this economic system, our economy is measured through a number called GDP. GDP is a measure of all spending that happens. But in GDP, it doesn't matter if you're spending money out of your bank account or if you're spending money on your Visa. And this is where the Federal Reserve Bank can cut interest rates, but that's not going to impact how much money you're spending out of the cash in your bank account, but it impacts how much spending that happens through your debt levels, because lower interest rates encourage people to go out and borrow more money. It's just like when Macy's has a sale. When Macy's has a sale, more people go and shop. When interest rates go down, more people borrow. And it's not just people, it's also corporations. And it's also the government. As interest rates go down, governments, corporations, people borrow more money. So when you have a debt problem and you still have an inflationary issue, is that the time to be cutting interest rates? Now, of course, we don't know exactly what's going to happen until it happens, but it looks like we should be expecting an interest rate cut because the Federal Reserve Bank doesn't really like disappointing Wall Street. We've been seeing that as a trend for many years now. Now, of course, I'll be keeping you posted on Market Briefs. Market Briefs is my free financial newsletter where every day, 6 times a week, my team is breaking down what's happening in the economy, in the housing market, in the stock market, in the crypto market, and the global economy into a fun and witty and easy to read newsletter. We have hundreds of thousands of subscribers that read Market Briefs every morning. It's a lot of fun to read and it's completely free. So if you have not joined Market Briefs yet, I got the link for you to join down in the description below. But this is where I want you to pay attention to what's happening, because if we take a look at the data, unemployment today is at 4.2%, which historically over the last 50 years is very good. But Jerome Powell says it should be better. CPI, inflation, is at 2.6%. Now, inflation is one of those things where it just depends on how you look at it. The Federal Reserve Bank says that inflation is not an issue, that we're on this path to 2%, even though we're really not going straight down. It's kind of been like going up a little bit in the last month. And at the same time, the reported inflation number isn't always the real inflation that you feel. Because if most of your costs are, say, housing and groceries, well, that's going up by more than 2.6%. But this is where inflation is an average, and the reported inflation numbers don't always give you an accurate depiction of the real inflation that many people feel. However, the real inflation number, or the reported inflation number, is still not at the 2% target that the Federal Reserve Bank has set. And this is where it's going to be very interesting. I say it's very interesting because it will be very interesting when Trump enters office, because he's going to change up our monetary policy. Number one is he's going to push for more interest rate cuts. Now, he can't set the interest rates because the Federal Reserve Bank is technically not federal. They're technically not a part of the government, and he can't technically tell the Fed what to do, but you can bet that he's going to put pressure on Jerome Powell and the Fed to cut interest rates. Along with that, he has been talking about tariffs, and there's concerns that these tariffs could potentially create some more inflation or price increases in the short term. We'll see what happens with that. And that's where countries around the world are already preparing for this. China recently passed their most aggressive stimulus measure since the 2008 Great Financial Crisis. They passed a $1.4 trillion stimulus as a way to combat tariffs and a potential trade war. And this is where the question is, why are they doing that? And they have made it pretty clear that they're doing it in anticipation of these potential tariffs that are going to be coming, because China's concern is that if America passes these tariffs, companies are going to pull jobs and manufacturing out of China. But the concern here for consumers is if you take that manufacturing out of China and you move it to another country or you move it to the United States, that means it might be more expensive to produce that product. Who's going to pay for it? Or if a company does not move their products out of China, that means there's going to be an additional tax on those products. Who's going to pay for it? Is the company going to eat up that cost and lower their profit margin? Or is that cost going to be passed down to consumers, causing the prices of things to go up? And this is where Trump is essentially saying that he is hoping that big tax breaks and energy cost reductions will offset any potential cost increases from these tariffs. And that's why I say it's interesting, because we don't know what's going to happen. Now, I am planning on making an in-depth video on tariffs and how they have impacted the economy in the past, because a lot of people are making these emotional arguments about tariffs, which is fine. But I like to really study history. So look out for that video coming in about a week or so. I'm still doing the research on that. But I'm going to do a deep dive on the history of tariffs. That way you understand how tariffs have impacted certain sectors of the economy in the past. That way you can get a better indication as to what's going to be coming in the future. But this is where many people are wondering, what do I do? And it really tears my heartstrings when I hear people looking for an easy way to find a trade or a quick buck or a quick flip, because those are the same people that end up losing the money. And those are the same people that are wondering why they never have a chance to build wealth. Because in reality, what we have seen throughout history is there's always been some sort of chaos, but long-term investors have won decade after decade after decade. For example, you might have heard the news that there's been a little bit of shakeup in the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market. And there are funds out there that allow you to invest in the S&P 500. Now, these are passively managed funds, meaning that these funds are managed by a computer. And so these computers have an algorithm as to what are the 500 largest companies in the stock market. And if a company, say, goes bankrupt, then the computer will kick that company out and put a new company in. And over the last few days, what we have seen is that two companies were just kicked out of the S&P 500. Quarva and Amentum were kicked out of the S&P 500 because those companies became smaller, and they were replaced by Apollo Global and Workday. What does that mean? Well, if you are, we'll call it a passive investor, where you're investing in something like the S&P 500, nothing changes. The funds that you're investing in are still there, but the companies that are invested in your fund have just been reallocated to kick out some of the smaller companies. Now, if you are investing your money actively, there's nothing wrong with that, but I think there's a lot of people that are looking for individual companies to invest in without actually understanding how do you research a company and keep up with the company, and then they wonder why they don't make money, even though the stock market has gone up by around 10% a year over the last 100 years. This is where you really have to know your strategy, because the way that you win as a long-term investor, especially if you are a passive investor, is through something called ABB. Always be buying is something I created. Now, I got to give you a little bit of a disclaimer here, okay? Because I am just a random guy on YouTube, and investing has risks, and you're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But here's the reality. Over the last 5 decades, 50 years, we have seen markets go up and down. We have seen market crashes, we have seen recessions, but despite that, the markets have continued to go up over the long term. Now, there are periods where the market has gone down. If you looked at it in April of 2020, markets were down. If you looked at it in 2009, markets were down. If you looked at it in 2001, markets were down. But despite the market crashes, the markets have gone up over the long term. And there's a lot of people now that are entering the market who believe that things are going to go straight up forever. That either Trump is going to make the markets rally with no corrections in sight, that Trump is going to make crypto continue to boom and never fall, that all these things are going to happen and markets are just going to continue to rally. And then you have the other side who believe that the market's about to crash because tariffs are going to destroy the economy. You have some people that believe that these new tax proposals are going to destroy the economy and it's going to create all these issues. Look, at the end of the day, there's always been shakeups in the economy. But what you want to do is be able to figure out how you can find the opportunity. Because there's some people that also just sit there and complain and find the problems with everything. That's not going to do you any good. It's not going to help you pay your bills. It's not going to help you take your kids to Disney World. It's not going to help you take something nice for your wife. If you want to have some nice stuff, you got to learn how to invest some money. Okay, if you want to build wealth, you got to know how to invest your money. Okay, if you want to have any freedom, you got to know how to invest your money, period. That's the way that our economic system works. Our economic system is designed to benefit investors, not designed to benefit employees. It's not designed to benefit consumers. Yet all we're taught to do is become an employee and become a consumer. Now, it's not bad to be an employee. In fact, most people, the vast majority of people, should be employees. But you have to, if you live in America or another first world country, you have to become a business owner. I'm not telling you to go out and start a business. And I'm not telling you to operate a business. I'm telling you to own a business. Invest your money. You could do this through the stock market. You could do this through investing in real estate. You could do this through investing in other assets. But you have to be an owner. And that's how the wealth is built. That's what our economic system does. It rewards investors. Over the last 5 years, the stock market has gone up by around 90%, while wages have only gone up by around 20%. This is not a new phenomenon. Over the last 5 decades, incomes have gone up by around 600%, while investments, the stock market, has gone up by around 4,000%. This is going to continue in the future, and that means you're going to have to spend some less money. That way you have more money to invest. Now, if we don't know how to invest, the simplest way to start is just invest your money into funds, like the total stock market. There are funds for that. You can invest in the S&P 500. That is the simplest way for you to get started, just to invest into broad-based funds to give you exposure to the economy. And then when you do it, follow ABB, because markets will crash, markets will go down, but just keep ABB. Always be buying. Buy when markets are up, buy when markets are down, buy when markets are sideways. Create an automatic investment every time you get paid. Whether it's every week, every 2 weeks, or every month, every time you get paid, just invest some of that money before you see it. There's your path to wealth. Now, as you get a little bit more sophisticated, if you do decide to get a little bit more sophisticated, now you can start to look for more advanced opportunities. You can start to look for more individual companies. You can start to look for real estate investments. Maybe you look for startups to invest in. Maybe you look for something a little bit more speculative. But you got to get started. And in order for you to get started, you got to stop spending all of your money. Because a lot of people right now are spending all of their money, and you're never going to be able to build wealth when you're doing that. And this is where you got to understand, look, there are issues in the economy. That's not something new. We've seen issues in our economy always. But there are some real concerns now. Even the Federal Reserve Bank is talking about it. But they're not really doing much about it. And a lot of times, people like to look back and say, oh, we should have done this, after the problem becomes a little too big. And that's why I want you to be financially smart. No one knows what's going to happen in 2025. Nobody knows what's going to happen in 2026. Nobody knows what's going to happen in 2027. Everybody has an opinion. But what you want to do is be able to build wealth no matter what happens. And the way you do that is always have some money put aside to protect you. Always keep investing your money and have money ready to invest to capitalize on investment opportunities that come your way. Now, if you say, well, I can't do that based off the income that I have right now, well, you got to figure out how you can spend less. And then you got to figure out how you can earn more. And once you do that, now you have the recipe to have money to invest. And then you just stay consistent. Investing is a long-term game. If you're looking to be rich by next year, don't invest your money. You're going to be very disappointed. But if you're looking to build wealth over the next decade or 2 decades, investing your money is the way to get there, because you're going to go through market swings. You're going to go through market ups and downs. But you got to be willing to part ways with that money, to put it into something that can actually grow. And a lot of times people are just trying to find the next hot stock, which is fine. But if you don't understand how to research, well, you're playing a very risky game. And that's why I want you to be able to build your wealth, but that starts with your own financial education. And that starts with you making some sacrifices so you have money to invest. So you got to have the money to invest, you got to invest the money, and then you got to research how you can make better investments. That way you can grow your money even faster. And with that, I will see you on YouTube tomorrow.